Awesome. Well, Lauren Goodwin, it's fantastic to have you back on the podcast. First repeat guest, actually. So that's pretty cool for everybody involved. We got rave reviews last time, so we're looking forward to another really great conversation. I'm going to attach your bio and a number of other things in the links included, but I would be remiss if I didn't go over a bunch of the things that you have achieved so far in your career. I want to talk first about the multi-asset solutions team that you are a part of. You're an economist and director of portfolio strategy at New York Life Investments. The multi-asset solutions team manages $11 billion among all the different strategies. That's a large sum of money to be shepherding. But what this conversation that we're going to have today, focusing on geopolitical risk, I just have to share with the audience how cool it is that you are now going to be authoring part of the, or all of the, Introduction to Geopolitics on the CFA Level 1 exam. For those of you who don't know what that is, just take my word for it. It is pretty badass, so congratulations on that. I'm going to jump in with an easy question. I'm going to keep it high level because sometimes these things can get really abstract. How do you think of, or how do you define geopolitics? We'll start there.
All right, well, it's an enormous honor to be back on the program, Jordan. Thanks so much for inviting me. And I promise this will be the only academic-ish answer I will give today. Geopolitical risk is a lot of things, but if I were going to define it as succinctly as possible, it's the risk associated with tensions or actions between actors. So actors could be individuals, it could be organizations or companies, it could be national governments, that anything that carries out a political or economic or financial activity. So tensions or actions between actors that affect the normal course of international relations. So geopolitical risk tends to rise when the geographic and political factors underpinning country relations shift. So that could be a change in policy, a natural disaster, a terrorist act, a theft, a war, I mean, you name it. So it's a lot of things, Jordan. Not all of those things are important for investing, which I think is an important theme we'll carry out today.
Well, fantastic. You touched on this, rising geopolitical tensions. I'm going to go ahead and speak for the audience right now when I say it feels like geopolitical risk, geopolitical tension is at an all-time high. Let's just use the past decade as a barometer. If you were to gauge where American investors stand right now at this moment in time as far as geopolitical risk, if you had to put a score, I'm not going to make you give me a 0 to 10, but just using the past decade as a guide, where would you say we stand as far as geopolitical risk today?
Well, you're hitting on a key tension related to geopolitical risk and how it applies to the economy and investing, which is it's really difficult to gauge relative to one time period or another, because geopolitical risk, the known risk that we face as a global economy or a U.S. economy, but also the unknown risks and consequences, they're always a part of the international environment and investing. So I'll give two caveats to that and try to answer your question more directly. The first is that we can, even if it's difficult to gauge risk one period versus another, we can gauge risks relative to each other based on their likelihood of taking place, the impact that they have on the economy or markets or everyday life, and the speed at which they have that impact. And I think we can also acknowledge that some geopolitical risks are more relevant to the economy and markets than others. So I'll give a couple relevant examples. Russia's invasion of Ukraine. Initially, the impact of that geopolitical risk was to all the proximate asset classes, things like natural gas and oil and Russian equities and the Russian ruble, you know, things that were very obviously connected to Russia or Ukraine. Give it a couple weeks and the most impacted asset classes included the German Bund, the German government bond. And so this geopolitical risk has now become a huge part of the global economic and market story. So even if we can't say that geopolitical risk is higher today compared to past periods, it's just difficult to quantify in any certain terms like that, we can certainly say that geopolitical risk is highly relevant for US investors today.
Sure. Now, the idea of relevance is huge, and you read about this in your CFA writing. I think that's a great transition into talking about relevance. So I think we all face geopolitical risk. Even if somebody invests in an S&P 500 index fund, there's going to be geopolitical risks there. Can you explain the idea of relevance of geopolitical risk from an investor standpoint, maybe even from an individual investor standpoint?
Well, I'm so glad you're asking this question because it's so important from an individual investor speaking with their financial professional, trying to gauge whether some of the risks they're seeing or hearing about are important, all the way up to the most sophisticated portfolio managers. This concept is key for everybody. Geopolitical risk can be so interesting and so potentially impactful that it often dominates conversations that we're all having around the economy and markets. I mean, it's just fun or at least interesting, maybe fun's the wrong word, but it's interesting to be talking about what might happen between the Russia and Ukraine moving forward. It's so interesting to talk about what China's circumstances with Taiwan might yield in the future. But the real question for investors is whether the risks that we're discussing or hearing about every day are actually relevant for portfolio outcomes. That's that concept of relevance that you're picking up on. And perhaps we'll talk about this more, but we use a framework that assesses the likelihood of a risk, the size of its impact, and the pace of its impact or the velocity of a risk to determine whether a risk is worth tracking. So the idea is if you're seeing something in the news and it sounds really scary or really interesting or really compelling, maybe it cues up an investment idea. The way to think about whether that idea might be worth tracking or pursuing is to say, hey, this risk is interesting, but is it likely to unfold? If it does, is it going to happen over the course of a couple of days, or is it going to take years to unfold? And if it does happen, is it going to have a big impact on the global economy or the US economy or my portfolio, or a smaller impact? And each of those factors help us to pull back a little bit on some of the interesting conversations that may not be as relevant for portfolio decision making.
Sure. So we're going to take it kind of to the institutional level where you operate in a second. I think this is a good opportunity actually to, speak directly to individual investors. Let's just take it back to the invasion of the Ukraine. I got plenty of phone calls that day saying, what do we do? What do we do? And I think this is really interesting to kind of show the different levels of protection that there are. Now, from my perspective, I'm perfectly happy telling clients, believe it or not, I'm not pulling the strings on which emerging market companies that we're investing in or not investing in, which countries we're investing in or not investing in. Part of what we do is decide what areas of the portfolio to employ active management from companies like yourself that we know do a hugely important due diligence process. If you can take these individual investors, clients of ours, anybody who's listening in, through the framework that you guys utilize at New York Life to decide, is this risk worth taking? Is this risk not worth taking? I think that would maybe calm a lot of people who think, it's a binary decision. Do I either buy stocks or sell stocks when Russia invades the Ukraine?
Well, exposure, as you're hinting at, is not always as straightforward as doing a quick search in the portfolio and seeing what country you're exposed to or what theme exists in a portfolio. Just as an example, US companies listed on US indices might have substantial international sales exposure and therefore be impacted by a geopolitical risk or currency volatility or commodity price volatility. And so it can sound like a really complicated exercise to look at everything you're invested in a portfolio and decompose it into the different types of exposures. And that is one approach that a portfolio manager or an investor can take to understanding their exposure. But as you can see, that's a complex exercise, and understanding the exact numbers may or may not be fruitful when it comes to, again, making intelligent or well-informed investment decisions. And so what we look at And what we try to assert to clients is, first and foremost, to just understand your risk tolerance. You know, when you're looking over the course of your investment horizon, what is the type of exposure to volatility that you feel comfortable with? And then that overall comfort with risk posture or risk tolerance can be managed by considering, you know, the volatility of asset classes overall over time, by the impact of currency volatility or commodity price volatility, some of the aspects of geopolitical risk that manifest most commonly in equity or bond investing, and where there maybe is appetite for those investments. Again, as you mentioned, recognizing that active management, you know, working with investors that can conduct bottoms-up credit analysis, who understand and monitor the one-by-one exposures that a portfolio might have to a geopolitical change. That's often a more prudent approach than trying to, for an individual to try and track it themselves, because the interconnectedness is just so complex. Leaving it to the folks who can do it day in and day out, we find is often a valuable exercise.
And that's a really important point. That I'll link this article as well. I don't know if you ever read Josh Brown from CNBC. He's got this blog, and this must have been a week after the invasion of the Ukraine, but he took a really angry tone in this article and was kind of, you know, berating people that sit in my position, financial advisors, financial consultants in general. And I think the title of the article was Say Less, but the premise was, you know, there was this expert investor who worked for BlackRock Emerging Markets, who knew everything there was to know about Russia and had a very long equity position on Russia, betting that Russia was not going to invade the Ukraine. The fund had a dramatic write-down, and kind of the last sentence of the article was, if this guy, Sam, the portfolio manager, got this wrong, what makes you think your, you know, investment advisor in the strip mall in suburban Detroit is going to get this call right? So I love that you're speaking directly to the individual investor, the client, that I have no business pulling these strings. That's where we rely on people like yourself and your firm to make these decisions, because they are so complicated. They're so nuanced, and there's a lot of moving pieces and parts at the same time. But I think it'd be interesting to drill down on a couple specific items. I actually listened to one of your more recent podcasts. I'll put that link in the notes as well. Let's talk about the US dollar and the movement that we've seen in the US dollar year to date, past couple of years. You choose the time frame, and how that represents potentially changing power dynamics globally.
I'm happy to. I think it's a great question. And I will just say that this is relevant for geopolitical risk conversations in two ways. One is the global power dynamics that you're mentioning, but the second is that currency volatility is the way that geopolitical risk tends to impact the market first. Sometimes it's the only way that a geopolitical risk tends to manifest in the markets. But certainly even in the more complex, more drawn out geopolitical risks, as they play their way through the global economy, it's that currency volatility that's impacted the most. And so for investors that like having a diversified global equity or bond exposure, they like to have a little bit of exposure, for example, to the UK or the Eurozone or Japan or emerging markets, whatever it may be. That currency volatility component is one of the ways that active managers can help to balance or build resilience of a portfolio to the things that nobody can predict, nobody can forecast. It allows them to act more speedily to adapt to a change in the risk environment than, again, perhaps an individual could. But then let's get to the other way that that currency is important in geopolitical risk, which is power dynamics. Now, I'll first give you a sense of our view on the dollar, which is that the current increase in the dollar strength, while a big benefit to any Americans traveling abroad, isn't so much about power dynamics as it is about the global economic environment. And the reason I say that is that the dollar in the short term, big moves tend to be driven by one of two things. They're driven by growth, global growth, because US financial markets are traditionally seen as a safe haven in times of slowing economic growth. And so the dollar and dollar denominated assets have tended to benefit when global growth is slowing. So that makes sense. When you see risks in the Eurozone and the UK and Russia and China, you might look for asset classes that are a little more resilient, and that tends to include the US dollar. And the other reason that the dollar's been gaining strength or tends to gain strength in times like this has to do with liquidity. So as global risks rise and investors may be a little bit more concerned about risk assets, they tend to look for more liquid assets. And again, the US has some of the deepest and most dynamic capital markets in the world. And so there again, demand for the dollar or dollar denominated assets tends to increase. And so as we move into what looks increasingly likely to be a global recession here in the next 12, 18 months, that increases both the growth concerns and liquidity concerns that investors have, increasing demand for the dollar. And I do believe that that strong dollar is likely to maintain its levels or near these levels for some time. Now, that said, I do want to address what you're saying about the global balance of power and acknowledge that part of the reason why so many assets are denominated in dollars, or why the dollar is, or king dollar is a concept in the markets, is because the dollar has had so much importance, and US financial markets have had so much importance in the global economy as US economic power has grown over the past several decades. And the question has been, as countries like China gain in economic prominence, does that threaten the dollar? And the answer is that could be the case, but it's a matter of decades rather than months or years. And I will say that this is a question, since I started covering emerging markets and geopolitical risk 15 years ago, I've been getting this question every year with what seems like urgency. And that's not to dismiss the concern, but it is to say that the institutional strength of the dollar, the importance and liquidity of US capital markets, the fact that many global commodities and other contracts are priced in US dollars, that's difficult to unearth. So of course we'll keep an eye on it, but for now it's not a concern of mine that the dollar would lose or gain even financial or economic power with any kind of haste.
Well, I'm much less qualified to speak on this topic than you are, but I'm so glad that it can take a number of different forms, but I just want to highlight one thing that you said. You're not necessarily saying one way or another, but you're saying over a long period of time, things will happen. That doesn't mean it's something, and I'll put some words in your mouth, that you necessarily trade off of in the short term. And that's what I think is lost a lot of times. We have financial media all over the place, and everybody, it seems to be in vogue to be getting news alerts and trading on a day-to-day basis. These really long-term investment themes are just that. They're long-term, and a lot of times there's not an investment decision to be made in the very short term to capitalize, avoid, whatever it is on those sorts of themes. So I'm glad that you highlighted that as well. So if we continue along with having you prognosticate on what you think is coming down the pipeline, near term, intermediate term, long term, what do you see as the most pronounced geopolitical threat facing, again, we're going to do this from the perspective of investors in the United States, and I'll give you a finite timeline. Let's go with over the next 10 years.
All right, that is a challenge I will accept. And I will preface my answer just by saying that neither you, Jordan, nor I, nor anyone can predict what black swan risk might come out of the woodworks that would impact US investors that we don't know about. But the things that we do know about and the slow moving, longer dated risks that I see are important. I'm going to cheat. I'm going to give you two because I think they're both very important. One has to do with energy security. And this isn't about the US in particular, it's about the globe. And of course, we're seeing that the dynamics of energy security play out after Russia's invasion of Ukraine, what that means for Europe. But I think that the global energy mix and the way that different countries make decisions around their future energy security, that's going to have really important implications for US investors. And I'll put that both implications, both meaning risks in that there's likely to be increasing costs and needs related to whether it's charging stations across the country, or other needs or partnerships that are developed. But those costs are just as much opportunities for investors. So if you need charging stations, that's an opportunity for infrastructure assets, just as one example. And so I think that question of energy security, who are the winners and losers of the global change in that dynamic, are going to be so important, and something that we're paying increasing attention to. To your earlier point about, this might not be a buy and sell every day, but it is a keep an eye on which companies or countries are developing the assets necessary to make these transitions. Keep an eye on them over a longer period of time. Now, the second risk that I think is really important, again, risks and opportunities for American investors, has to do with China, and specifically technological security. Now, what I don't mean to do is fearmonger and say that, oh, China is a major risk to US investors. That could be true, but that's not really the point that I'm trying to make. What is happening is that China has been developing its own sort of e-security infrastructure, technological security infrastructure, its own companies and products and infrastructure for technology. And those different products and processes have been put in stark contrast or competition with US products and processes aimed at doing very similar things. And this is an area that both sides of the geopolitical aisle, both the US and Chinese governments, have occasionally postured in competition to one another. And I see this as being important for US investors, again, not only for the interesting ways in which opportunities to develop new infrastructure or ideas might present themselves, but also in the risks, especially related to cybersecurity and the processes and risk management tools that companies will need to employ to maintain their security over the long term. So I think one of the most important takeaways about both of these risks, as you've probably seen from my answer, is that while these are risks to US investors in the long term, there's all different types of ways that monitoring these risks could present opportunities as well.
Sure. Now, globalism is an interesting word because a lot of people hear it and it's this, four-letter word that you need to run away from. I see it as more of just a word with a definition, like a bunch of other things that get charged depending on who's using them. One of the arguments I've heard is that there's no doubt over the past couple of decades we've seen an increase in globalism, and I'm now hearing this narrative that the next decade plus is going to be marked by a change in direction of globalism. Is that something that is that a trend that you buy into? What are you seeing?
All right, two important things to bring up with respect to globalism. The first is that it is possible that we see some sort of deglobalization. US companies, for example, moving production back to the US, for example, instead of some international country. But what we have seen more often than not over the last, frankly, decade or more, as labor costs in other countries, including China and many of the former USSR countries, as those labor costs have risen, is more expanded globalization. So instead of doing, all of your international production in one country like China, you might have some production in China and some in Malaysia or Singapore, et cetera. And so I think the jury is still out what the historical record will reflect 10 or 15 years from now. But I expect that just as much as some companies may make the choice to build resilience in their supply chains by moving production home, whatever home means to them, there are going to be others that build redundancies in their supply chains by creating or producing products and services in more than one international country. Now, that said, the pace of globalization had been increasing over the course of the past several decades, and it is possible that we've reached somewhat of a peak in how much globalization can really expand. But I don't necessarily think that deglobalization has to be a geopolitical risk, although of course anything can become one. But the other thing I'll just mention, which has to do with globalization more broadly, is that it makes commerce, or it has made commerce, an important part of the conversation on geopolitical risk over the past several decades, because Globalization means that more actors, whether it be big personalities that have a soapbox now that there's the internet, or companies that have a global reach, those actors can have more impacts on countries than they did in the past. So a national government, for example, in its relations with other countries might have to consider the impact that any choice has to its global businesses, for example, its multinational corporations. And so certainly globalization makes geopolitics or geopolitical risk more complex. But that doesn't mean that it increases geopolitical risk in a bad way necessarily, because just as countries might have to consider the negative impacts of any change on their companies or their citizens, et cetera, that very interconnectedness may make any rash changes in policy less likely, because there is that impact, or there would be that impact to their other actors in the global sphere. And so globalization, deglobalization, neither of them have to be bad. They're just different. Now, of course, they do have implications on the type of investment opportunities we'll see, but again, not necessarily negative or positive in either direction.
So if we're giving you the final word to speak directly to individual investors, we've covered a number of different topics here. I think there's no confusion behind the idea that this is really complex stuff. If somebody is intimidated about investing in general, don't even want to buy, an S&P 500 index fund because of these geopolitical risks, what would you say to somebody about not necessarily whether or not to invest more broadly, but how to handle the idea of investing in an increasingly or a seemingly increasingly geopolitically risky environment?
Well, I'd say a couple things. The first is, again, that geopolitical risk can feel more present as we're living in a 24-hour news cycle, as we're hearing different types of threats around the world. But geopolitical risk has always been a very important part of the investment universe. And risk as a term can mean both upside and downside. So while there are certainly geopolitical risks that can have an impact to a portfolio in a negative way, they can also have an impact in a positive way. And one of the things that is so important about considering those risks is, again, to consider your investment time horizon, because there's geopolitical risks out there, there's economic risks out there, et cetera. And it is so difficult to time or predict any of those things. The only thing as investors that we do know is that on a 1, 5, 10, 15-year time horizon, staying invested has been a strong, if not the strongest way to build long-term wealth. I'd like to just add a little asterisk for the current environment, which is to say that that is increasingly true in periods where inflation is high, because running for the hills in an investment portfolio, moving to cash or just government securities as an example, that can create a drag on a portfolio when inflation is high. And so much like any of the other risks that impact us in the economy or in politics, there's a very an element of keep calm and carry on here, remembering that risk is a part of the investment equation, and it's one that financial professional, active portfolio managers are here to help manage over the medium and long term.
I'm gonna have to go through this and pick out all the gold nugget quotes that you just dropped on us, because a lot of them are so true. I think people are sick of hearing me say it, so hopefully hearing you say it will definitely reinforce those ideas. Like I said, I'm gonna link your podcast in the show notes. I think people would really enjoy it. What is it, 15 to 20 minutes per episode? I listen to all my podcasts on 2x speed, so I can listen to 2 by the time I get to work anyway. There's a lot of really interesting information there. I'm also going to link some of your writing that we referenced that's going to be part of the CFA curriculum. But Lauren, I really appreciate you taking the time. This was as good as I expected, if not better, and I'm really looking forward to seeing how these themes that you discussed unfold over, well, not only the next few years, but the next few decades.
Thank you so much for having me, Jordan. And thank you to your listeners for the time. I know it's very valuable, and I hope to see you soon.
It is our pleasure. Thank you.